It's been a big few weeks, including the federal budget, the Reserve Bank monetary policy statement, and the French presidential election. Now some of this uncertainty has been removed. Where are the markets likely to head? We'll update our forecasts ahead of the end of financial year. The federal budget didn't have much impact on the markets, as its implications for interest rates, the Aussie dollar, and stock markets were fairly limited. But the threat of a downgrade to our AAA credit rating was avoided, as hoped, with a cash surplus projected in 2020-21 and net government debt still not projected to exceed 20% of GDP. Each of the three ratings agencies have given their tick of approval, which is a good independent test. The positives beyond this included infrastructure investment, totalling over $70 billion, including the second airport for Sydney and the Melbourne to Brisbane rail line, and funding for the NDIS, via a 0.5% increase in the Medicare levy, plus a range of measures such as super salary sacrifice for first home buyers and schools funding via Gonski 2.0. The controversial measures in the budget included the 6 basis point liability levy on the Big Four banks and Macquarie Bank. And while they've been screaming blue murder over this, they will benefit from Australia keeping its AAA credit rating, so their contribution will help all parties. Despite the impact of this on bank stock prices, the ASX 200 is higher, and equity markets around the world are still performing relatively well, certainly helped in Europe by Macron's win in France. Fortunately, the fears in Europe of a shift to the far right after Brexit and Trump haven't been realised, with Austria, the Netherlands and now France passing that test. The VIX level of volatility in the US markets, sometimes called the fear index, is close to multi-decade lows. So as we said in our last update, the markets are still taking the range of geopolitical risks in their stride. And even with the prospect of higher rates in the US, plus some mediocre data out of China, there is still no sign of panic in the market. So our predictions now are similar to where they were at the start of the calendar year. Still expecting the RBA to be on hold for the year, but with an eye on inflation and housing prices. We're still expecting growth to remain in the 2 to 3% band, with no recession on the horizon, unless the Chinese outlook deteriorates, and the Aussie dollar still in its reliable 72 to 78 cent band, but admittedly looking more like testing 72 cents now than breaking 78 for the moment, or at least until lasting damage emerges from Trump's protectionist policies, which ultimately pose significant risks to the US and eventually to the US dollar. And finally, despite some flat retail sales numbers out here, both business conditions and business confidence remain in positive territory. And while the mining states had been lagging New South Wales and Victoria in this survey, WA seems to have bridged the gap a little, and Cyclone Debbie appears to have had a smaller impact on Queensland than initially feared. Again, the lower Aussie dollar is helping with this, as is the better global growth outlook, as outlined in recent comments from our Reserve Bank. And that's the market update from Bendigo Bank.